Ladies and gentlemen, good afternoon. My name is Alex Benos. I am the CFO of Cenergy Holding, and I welcome you to today's live webcast on our company's 2025 first semester financial results. Our agenda today is to present first group financial figures, give you a short overview per segment, and then talk a little bit more about what is coming up for the end of the year and for 2026. So, the main point of our results is really the following. We had a very strong first semester, both at the top line and at the bottom line. Both facts have led us to update our 2025 fiscal year guidance on adjusted EBITDA, as I will make clear in the following notes. First of all, our revenue has exceeded the 1 billion mark on a semester basis. I remind you, it was only 2021 when we hovered around 1 billion for yearly sales. Now we have come really a long way since then, and we've gone over the 1 billion mark for the first semester, a 26% increase year on year, so related to H1 2024. At the same time, that increase in sales is coupled with an operational profitability which is above 170 million euros, 43% higher than the first semester of 2024, with both segments exhibiting superior performance. The steel pipes achieve an exceptional margin over 18% due to their favorable product mix, while cables have incorporated the additional capacity on the submarine cables that was developed at the end of last year in the Corinth plant of Fulgor, and can now reap the fruits of that additional capacity. There was a ramp up that took a little bit more time than the first quarter. Now all new lines are fully operational. That's why Q2 is really much stronger than Q1. Margins for both segments have increased more than 200 basis points compared to those in the first semester of 2024, while the backlog is still very strong at 3.33 billion, which gives us a clear visibility of over 3 years for cables and a period around 18 months for steel pipes. All of those, of course, lead us to update our 2025 financial year guidance on adjusted EBITDA to 340 million euros, which is 10 million euros up for both ends of the interval. The return on capital employed is also very strong at 29%, and it is expected to stay there for the year end. Now, the figures per product line show clearly our strategy, which is focusing on value adding and therefore high margin areas. If you look at the details of that slide, the split between Hellenic Cables, so the cable segment, and the steel pipe segment is a 70-30 split, both in terms of sales and in terms of profits. But it is also clear that what we name projects in both segments have received or have produced, it depends on the way the way you look at them, the lion's share of profitability. So Hellenic Cables projects at 409 million euro of sales, 63% higher than the corresponding semester of 2024, are representing 55% of the revenue of cables, but around 80 to 82% of the profitability of cables. At the same time, steel pipes projects, which is really the lion's share again of Corinth Pipeworks sales, represent 260 million, so 93% of the revenue, and more than 95% of the profitability. So it is clear that the projects is where both segments are focusing on, and that is what they want to keep on developing for the years to come. Our sales remain geographically dispersed, although we can see that there is a kind of slow shift towards Europe, at least more than what was true 1 or 2 years earlier. Now, some of it is due to specific projects that were executed in 2023. For example, in 2023, the large share of Greece was due to the execution of the interconnection projects in the Cyclades and in the Ionian Sea, Kyllini Zakynthos, whereas in 2024, the large share of the rest of the world was really due to two projects by steel pipes, one by Chevron in the coast of Israel, and another one by Total in Australia. So that shift is not a shift that has been made away from Greece or away from the rest of the world, but it is true that our interest is centering around Europe, more for the cable segment, since the cables are really playing very strongly the card of Europe's energy transition and its focus on renewables, while we develop, of course, our factory in the US to serve the American market. On the other hand, Corinth Pipeworks remains a truly global player, so it doesn't have, well, I wouldn't say a lot, but it doesn't have a significant amount of sales in Greece, apart from simpler and smaller DESFA projects. It's really aiming at a global presence. The growth in top line, of course, is very good, as I presented before. We have a 26% increase year on year, with Q2 being better than Q1 due to the increased capacity in the Greek factories of Hellenic Cables. In the value-added areas, which are what we call projects, this means that the delta of turnover translates by a multiplier of more than 1.6 times to an increase in profitability. So the 26% increase in revenue becomes a 43% increase in profitability, and we reach a number of 171 million for the semester. The weighted average margin of this is at 16.7%. As I said, more than 200 bips higher than last year for both segments. And the backlog is also above 3.3 billion, rather stable, mostly in the Hellenic Cable segment. And we have, of course, the potential for further increase by the end of 2025. The stability of the backlog in Hellenic Cables is not something that is alarming for us. Much the contrary, we have earned some good awards, like the Dunkirk offshore wind farm by RTE and the very recently announced interconnection between Igoumenitsa and Corfu in Greece. It's just due to the fact that during the first quarter, Hellenic Cables executed a much larger amount in euros of its existing backlog than the awards it won in the first semester. On the contrary, CPW actually had the opposite effect. It executed less than the new awards it got. That's why its backlog is now up to around 560 million euros. We are also present, as I told you, in the US. This cables project is a project of 230 kV subsea export cables for the US. It's a part of our backlog, but of course it will link very favorably to our local factory when that will become operational in around 1.5 years. What is more interesting is the non-quantitative features of that backlog. And that's what I would like to mention to you right now. First of all, the cables backlog is more balanced between offshore and onshore project than it was in December 2024. With all the questions that have been raised lately on global offshore wind farms and so on, I believe that this is a much more prudent approach for our segment. And on the other hand, as I said before, Corinth Pipeworks, the steel pipe segment, is now a global tier one top supplier of large diameter welded steel pipes. Why is that important? Because natural gas remains indeed the largest part of its order book, but it has a very strong presence in the new energy transition projects, meaning the carbon capture projects and less the hydrogen-related projects. I just mentioned the Liverpool Bay CCS project in the UK, the BP CCS project also in the UK, the Adriatica lots that we got by Snam in Italy, which require hydrogen-ready, 100% hydrogen-ready pipes, though hydrogen is still considered a long-term eventuality in the market. But it shows that CPW may have a large part of its current backlog in the natural gas market, but it has a strong presence as well in the new energy transition areas like CCS and hydrogen. Of course, the high profitability will trickle down from EBITDA to profit before tax and to profit after tax. So profit before tax and profit after tax are up by 70% compared to the corresponding semester of 2024. We are very happy that we have achieved that for all our shareholders and stakeholders, and we believe we will keep on doing that for the year end as well. And if we look at the gaps, the bridge between what was true last year, 73 million PBT, and this year, 123 million, it is clear that this increase in profitability came from operational profit in both segments. 43 million in cables, 10 million in CPW, and another impact, a smaller one, the lower finance expenses, which led to the 124 million number. Now, these net finance expenses are lower by 2.4 million. We had lower interest expenses for our debt-bearing instruments by more than 6.5 million euros due to lower spreads and lower reference rates, and also a positive impact from interest received on the amount that we raised last year from the share capital increase. That was counterbalanced in a significant part by accounting losses on our FX positions, due just to the fact that for hedging purposes, we had a part of that amount raised in the share capital increase turned into dollars at rates which at the time we converted it were much higher for the dollar than they are right now. So we have to write this accounting loss on FX as a finance expense. Turning to the returns, as noted in our CEO's message, Cenergy keeps on delivering returns, both to our shareholders, older and newer, those that joined us after October 2024, and also all the other stakeholders. The earnings per share are up by 50% to 45 cents per share. The share price has reached levels more than 11 euros, which is 25% higher than the share capital increase price. And as I mentioned before, the adjusted return on capital employed has gone over 29% and is expected to stay there until year end. Profitability also fuels some capital expenditures and is fueled by these capital expenditures. I must admit that these capital expenditures are at a lower pace than last year, but they are still important to keep the business growing. Our net debt has increased to 343 million in June, mainly due to the rise in working capital of 157 million, to levels which are clearly closer to what we would call stable ones. I remind you that the negative 6 million of working capital for December 2024 was really an extraordinary amount. It was due to specific down payments that were received in the last month of the year. And as I have also mentioned again many times in the past, the normal working capital levels of the segments can be found around the 7% vicinity for Hellenic Cables and the 10% for Corinth Pipeworks. So that's where we really expect in a steady state our working capital needs to be. Our CapEx this semester was at 119 million. It is broken down as follows. We have spent 49 million, for the finishing up of the expansion of the Corinth plant. Another 40 million for the land cables factories, which are upgraded, and the upgrade of the Thiva plant is expected to be completed by the end of 2025. In Eleonas, which has been operationally since last year, there is an ongoing ramp up. Eleonas is really a full development from scratch, I would say, from the old Petzetakis factory that we acquired some time ago. We are now building there a center of excellence for low voltage power cables. In the US, the expense in the first semester of 25 was 15 million euros, a little bit less than forecasted. It will clearly ramp up in the second semester. And let me be clear here, this lower expense in the first semester does not mean that there has been a slowdown of works. This was only due to some delays in our suppliers' invoicing. So there is no delay in the building and the development of our Maryland cables facility. Finally, another 10.5 million were spent by the Corinth Pipeworks for upgrades of its port, improvements in coating, in cutting, and also in developing much greener energy for the production facility, as we will announce very shortly a major project that we did on the Thisvi plant. All of this CapEx, of course, was financed partly by the new debt and partly by the profitability. So in a sense, the change of net debt that we have shown in our financial results is due to an increase of the working capital, as I told you, and the rest is a need for capital expenditures. Now, if I go to the overview per segment, it's clear that we have a very good performance by cables. They still run on that mega trend of electrification and greener energy that has really pushed their profitability to 121 million euros for the first semester at margins which are extremely strong, 16.3 weighted average, which is really something between the 20 plus margins that we get on projects, especially the submarine turnkey projects, and the single to low double-digit margins that we get on the commodity products. The net debt, of course, is higher because most of the working capital needs and the increased CapEx was done on the cable segment. For the steel pipes, I should really congratulate the segment on achieving a very strong and exceptional 18.2% EBITDA margin on their sales of the first semester. This is really due to a quite favorable product mix, but also to the position of Corinth Pipeworks as a global top quality provider of steel pipe for different gas fuel networks. They do not have anything special to show either in net debt or in working capital. They are a much more mature segment right now. So that brings us to what we expect for next year, for the year that finishes and for next year. Let me start with cables, and I believe this is one of the most important points that I would like to note this afternoon. There has been a lot of discussion on the possible decrease, the possible crisis in an offshore wind farms and the offshore wind market, and so on. This is really something that we do not observe in Europe. In Europe, offshore wind farms and renewables remain very strong. Hellenic Cables is positively engaged in a number of tenders in the UK, in Scandinavia, and elsewhere, and in a number of frame agreements. And that is shown by their success and will be shown by their success in a market which continues at having quite significant amounts tendered. Just to give you an example, the total projects which will be tendered offshore by the end of the year and beginning of 26 are over 6 billion euros. And for onshore, this total is around 3 billion euros. And we're talking about big clients like RWE, Scottish Southern Power, Copenhagen Developers, Energinet, E.ON, 50 Hertz, large European TSOs, transmission operators, DSOs, distribution operators, and also offshore wind developers, which are continuing to bring to the market projects important for the electrification of Europe, for the greener energy and greener electricity in Europe. That's why our backlog is expected to rise significantly until the year end. I mean the cables backlog. We are around 2.8 billion now. As announced last week, the Hubenica project is only a small part of this extra amount that we expect. And we are confident that until the end of the year, there will be more awards to Hellenic Cables. A second important point is the demand for power grid enhancements. Now, that is clearly related to the need for electrification. The grid operators, what we call the DSOs, want to modernize and expand their networks. And research papers show that medium voltage demand globally could reach $66 billion by 2030. I repeat, this is a $66 billion demand for medium voltage cables. I stress the medium voltage because this is where most of the distribution cables are located. The research of specialized institutions show also that electrification will lead to a CAGR, to a constant annual growth rate of around 5 to 8% a year, with the US getting 25% of that and Europe getting around 30% of that. So imagine we're talking about 60 billion, divide by 4, so the US will get around 15 billion and Europe will get around 18 billion of that demand. So that is extremely important for us because it gives us quite a satisfactory visibility for our US factory, which will begin its operations in 2027, and we're confident that there will be a lot of demand in 28, 29, and 2030 to fill up the factory and bring some profits to the group. That point is also linked to, especially for the US, to a rise in electricity demand. The American Institute for Energy Autonomy has shown, has published a report that it's the first time in 2024 that the global demand of electricity in the US, so the demand for electricity in the whole country, has increased by 2%. All previous years, the demand for electricity was rather stable. And that demand for electricity is expected to run at higher paces until 2050. They actually predict that computing needs will be what will need most of electricity by 2050, with ventilation and air conditioning, unfortunately, I would say, taking second place in the need for our electricity by that time. Finally, I would like to give you some update on our US plant. As I said, the small delay in the CapEx spending is in no way related to delay of works. Works are going as expected. Foundations are ongoing. We have finished the soil removal, and we turn to what we call rigid inclusions and the formation of roads inside the area by the end of the year. In the meantime, our company in the US focuses on 4 areas concerning our future operation there. First of all, the qualifications that we need to get for our cables. Qualifications, I mean the qualifications for cables to be accepted and by the local utilities, the famous UL mark, product development specific for the American market, and so on. The second area is, of course, tendering. We try to be present, although we don't have a factory, to be present already and to develop the intelligence that is needed, not only for short-term bids, but also for long-term multi-year contracts. A third area of focus is, of course, organizing the teams there and building the teams of sales, of engineering, of finance, and so on. That will be necessary. And finally, marketing. Let's not forget that area of business, meaning that the teams there have to be present, and they are present in all conferences, trade shows, road shows that concern the cables market at large in all of the United States. As for steel pipes now, the first point that I would like to make is that natural gas is still the main energy source. All institutions and all institutes that do research, they do not expect natural gas to peak until after 2035. So it remains the main energy source of our Earth. This demand, as a total energy demand, is also growing. It's growing maybe not in where we had assumed or expected at first. For example, hydrogen being, the clean gas and the clean production of energy. But in 26 and 27, most of the cleaner fuel market will be taken by carbon capture projects. There are a lot of opportunities for steel pipes in Asia and Pacific Ocean, Indonesia, Malaysia, and so on. And also the demand for LSAW pipes, the longitudinally welded pipes, remains very favorable until the end of 27. About specific markets, I would say that for us, for Corinth Pipeworks, the US offshore market is a good environment for our development, since that is where high quality is absolutely necessary. When I say US offshore market, we really mean Gulf of Mexico or Gulf of America, depends on how you call it. The US onshore market is mainly not controlled, but mainly served by domestic producers. We have, of course, some opportunities there, but they are more limited due to the tariffs as well coming in. In Europe, the offshore market is also very strong. We are talking about good prospects at the CCS area, especially in Scandinavia, and in terms of oil and gas in the Mediterranean and the Caspian Sea. Whereas onshore, there is demand for onshore networks in Italy, in Germany, the UK, both for gas and CCS. Of course, there's competition. That competition and the globality of presence of CPW makes our visibility more limited. The competition mainly comes from the Indians that do invest a lot in increasing their capacity. Koreans and Chinese are strong, but they are strong in simpler products. I mean, more commoditized products, not the niche, high-quality, sophisticated pipelines that Corinth Pipeworks producers. Of course, politics are not that favorable for them right now, so they are not that present in the global markets or in the Western market, to be more precise, as in the past. All of the above led us to be a little bit more optimistic about the end of the year. That's why we upgrade our guidance for the fiscal year 2025 to a range for our adjusted EBITDA between 310 to 340 million euros. I also remind you our financial calendar until next year. On the 19th of November, there will be a training update on our Q3 results. On the 20th of November, I will be happy to welcome you again and give you an update on that Q3. Then we do have the financial results of 2025. The press release will come out on March 4, 2026, with the conference call following a day later. And the ordinary general meeting for Cenergy Holdings is expected on the 25th of May, 2026. So this concludes my short discussion on the 2025 H1 financial results. I now turn to the operator to organize a little better the Q&A session. Thank you.